it really screws with your psychology. The market is not satisfied until everybody loses. And I want to point everyone's attention today to what we're seeing in the two areas that if we've seen enough pain, and if we're really going to avoid a recession, the two areas that should not be doing what they're doing today, one is travel and the other is consumer discretionary. So Expedia had actually an earnings report where their revenue doubled, up 100% year over year. But for whatever reason, the details weren't good enough. And that stock is now acting like all of the rest of the technology stocks, despite the fact that literally the hottest category of all of consumer spending right now, travel, and this is the company that most accurately represents the trends in that space. It's not a hotel, but it has hotel exposure. It's not an airline, but it has airline exposure, et cetera, et cetera. So Expedia had all good things to say, even on business travel, and they're crushing it. And look at everything else falling in sympathy. Booking, Marriott, Hilton, MGM, Caesars, on and on. Okay. Airlines not as bad. Consumer discretionary is the big underperformer today. Nike down 3%, Ulta down 1%, Domino's down 3%, Chipotle down, Starbucks down. You can't have those stocks not working if you're saying that, oh, we've had enough, the market's had enough. Those are the stocks that have to catch a bid here. And they might. But really and truly, if the consumer doesn't hold up, the whole shooting match is over.
Let me ask you this.
So far, the consumer has, but we're seeing signs that at the edges, there's some hesitancy to pay prevailing prices, and it's not the best thing to see right now.
So be careful how you read into some of those names, because as Mike Santoli flagged for me, literally minutes before we came on the air, Expedia, Live Nation, Josh, that's a U stock, Datadog, Cody, Hilton. Those are also Melvin Capital stocks, which we find out that fund is down a lot year to date. There are some questions about what the future of Gabe Plotkin's fund is going to be. And maybe they're going after some of the names in anticipation of him liquidating. I don't know, but that's certainly part of the conversation around those specific names.
He's not big enough.
So,
yeah, he's not big enough. It's a sideshow. I got it. Well, last thing.
Nonetheless, just be careful how you read some of the activity in some of those names, given how, people come after those kinds of names at times like this.
Sure. Last thing. I think there's two categories of stocks right now. The ones that I'm interested in. The ones that are working currently. One of the trades that I gave on the show that I'm personally doing, ITA, which is defense and aerospace, acts really well. Looks great right now. The other, IEO, this is energy producers, also very close to 52-week highs, looks great. That's what's working now. The second question is, what's the fat pitch being created by all this volatility? And I have to tell you, I really feel it's biotech. The biotech stocks have come down almost as much as the rest of the Nasdaq and the rest of the growth stocks. The difference is they're not cyclical. Like the science of shrinking tumors is not affected by whatever Jay Powell decides to do this week. So I think that is going to be the fat pitch, but I still think it's too early.
Okay.
At a certain point, though, if you ask what flush do I buy, I think you want to look in that area.
Right.
Life sciences, biotech, they're going to be huge winners.
So, Steph, this question of whether we've had enough pain, whether there's too much pessimism in the market, Ed Yardeni asks that today. And it also comes on the heels of a conversation I had yesterday in overtime with Eric Johnston of Cantor Fitzgerald, who says you're going to get a violent move higher in May. The whole thing's going to come in May. 8 to 10% on the S&P. It's an interesting call. You match that up against Paul Tudor Jones today, who was on Squawk Box. Quote, you can't think of a worse environment than where we are right now for financial assets. You don't want to own bonds or stocks, he said. So you got cross currents all over the place.
You do. You absolutely do. You have a push-pull going on right now. So on the one hand, you actually have pretty good economic data. I mean, look at the ISMs, the PMIs, look at factory orders today. How about those job openings at a record? I mean, we now have more job openings than unemployed people. So the economic data has been solid. Earnings have been solid, actually. 75% of the S&P 500 have beaten by about 8.5%. And actually, estimates are going higher. only by a little bit, but they are going higher. We're on track to do 12.5% in earnings in the first quarter and probably about 9 or 10% for the full year, right? But so those are the good things. The bad things are the things that we've all been talking about ad nauseum. The Fed, inflation, war. I mean, the Fed is going to try to engineer a soft landing, and they don't have a very good track record of doing so. And so that has led to multiple contraction, even in the face of earnings going higher. So we're now at 17.7 times for the S&P 500, down from 21.6 times earlier in the year. Can we get to the average? We sure can.
Okay.
16 is the average. Could we go lower? Can we go lower? Yes, we could. It's impossible to know. We are going to be in a choppy range for the entire year, in my opinion. We may have a nice rally in May. That's great. But we are going to be data dependent and watching the Fed all year long. And that is going to be a problem for equities. And that is why I have said all year long that I want to have more of a balanced, diversified portfolio. Yes, I still own energy and materials and financials, but my latest purchases have actually been on tech and healthcare. So I'm trying to find ideas and opportunities and staying patient.
So lastly to you, Farmer Jim, again, Steph points out a lot of good. She points out bad, too. And the question is, and the most important question, frankly, in the market is the bad too much for the good? Is the Fed going to ruin all the good because of what it has no choice but to do? The task at hand of what Ken Griffin talked about yesterday out west, more uncertainty, or at least the most uncertainty since the GFC, global financial crisis. You got Tudor Jones on the network today talking about the environment, too.
Yeah, and Scott, I think this is a question of what Steph just said. Can the Fed engineer a soft landing? As she points out, there isn't a good track record from the Fed. But, ultimately think about what the Fed's mandate is. Maximum employment, they've got that, and price stability, which they're working on. And if you look at some indicators, it may indicate that price stability is closer than we think. The ISM survey yesterday, the manufacturing survey, showed a market decrease in prices paid. You've got freight costs coming down. You've got inventory to sales in corporate America picking up, all of which should put lower pressure on inflation. If this Friday you get a good pickup in labor force participation rate, that could be another signal that inflation has peaked, not is peaking, has peaked. The real tell will be next week when we get the April CPI. That's what I'm waiting for. Between now and then, we know what the Fed's going to do. Earnings have already really been shot for this quarter. There's still some coming in. But what I'm really paying attention to is next week's inflation, because if there's wind that comes out of the sails of the aggressive Fed, this market will rally. Again, for the reasons that Stephanie pointed out. The effect has been on the multiples. Yeah. Right now, we're trading at 16.5 times next year's earnings. If you get a little ease off from the Fed, that could easily pop up to 18, which would be a 10% rise.
And even if it has peaked, it's still high, right? 40-year high, you got to bring it down.
Yeah, but that's not what matters. That's not what matters. It's the direction, not the level. It's the direction.
Well, let's do this. Let's take a break because we're going to talk more about the markets with Altimeter's Brad Gerstner. He joins us in a CNBC exclusive next. He made a big call last fall about a pullback in high valuation tech. He was darn right, too. So what does he see now? He'll find